Microsoft just reported earnings that beat on revenue, profit, and operating margins. The stock dropped anyway. Why? Because they spent $29.9 billion in cash on property and equipment additions in a single quarter, plus additional capacity funded through finance leases. And the return isn't showing up where investors expect to see it. But here's what we found. Digging through the filing and the earnings call, Microsoft isn't just building Azure. They're building a portfolio of AI products with completely different economics. And the return is already showing up, just not where analysts expect. In this video, we'll show you where that revenue came from, why margins are compressing even as profits grow, and how Microsoft is allocating infrastructure spend across products with very different margin profiles. By the end, you'll understand why that capital expenditure is funding two different businesses, why Microsoft is choosing to hold back Azure capacity, and what three metrics will tell you next quarter if this strategy is working. This isn't about stock predictions. It's about reading the business the way management is actually running it. The market is asking, where's the return? Microsoft is answering, you're looking in the wrong place. Let's break down what the numbers actually show. Before we dig into the segments, let's talk about what happened on the earnings call, because CFO Amy Hood made 3 points that most coverage completely missed. And these 3 points are critical to understanding where that CapEx is actually going. First, management said on the earnings call that if Microsoft had allocated all their new GPUs to Azure instead of their own products, Azure growth would have exceeded 40%. Not the 39% Azure growth they delivered this quarter. So they're deliberately choosing to hold back Azure capacity. Second, Microsoft disclosed significant concentration risk with OpenAI on the call but did not quantify it in the filing. What we do know from the 10Q, commercial remaining performance obligation, was $625 billion with a weighted average duration of approximately 2.5 years. Third, the average contract duration extended from 2 years to 2.5 years according to the filing. For GPU contracts specifically, management indicated on the call that they're selling long-duration commitments that extend across much of the hardware's useful life. Because if you only track Azure growth, you'll miss where the return is actually showing up. So let's look at where the money actually came from, because the revenue breakdown tells you exactly which businesses are winning and which are being left behind. All right, let's talk revenue. Microsoft operates 3 segments. 2 are growing fast, 1 is shrinking, and the split between them reveals everything about their strategy. Productivity and business processes brought in $34.1 billion, up 16%. Microsoft 365 Commercial Cloud, that's Office, Teams, Exchange for Businesses, grew 17%. Growth came from 2 places: more expensive E5 licenses and Copilot subscriptions. Management reported on the call that paid seats hit 450 million, up 6%, driven by small businesses and frontline workers. Microsoft 365 Consumer Cloud grew 29%, driven by higher subscription prices, not more subscribers. Subscriber growth was just 6%. LinkedIn revenue grew 11%, driven by marketing solutions. Dynamics 365, their business app suite, grew 19% across all products. Now let's look at the cloud business, the one everyone's watching. Intelligent Cloud brought in $32.9 billion, up 29%. Management reported on the call that Azure and other cloud services grew 39% in constant currency. That's slightly ahead of expectations. They cited ongoing efficiency gains across their infrastructure fleet that enabled them to monetize more of their existing capacity. But they were explicit. Demand continues to exceed available supply. Their on-premises server business, SQL Server licenses sold to run in your own data center, grew 2%. Management attributed this to the launch of SQL Server 2025 and customers buying ahead of expected memory price increases. And then there's the consumer business, which is struggling. More personal computing brought in $14.3 billion, down 3%. Windows OEM grew 5%. Revenue Microsoft gets when PC manufacturers install Windows on new machines. The benefit came from Windows 10 end of support, pushing businesses to upgrade. Search and news advertising revenue grew 7%. Ex-TAC, it was up 10%. Both below expectations. Management called it execution challenges. Gaming revenue fell 9%. Xbox content and services declined 5%, missing forecasts due to weak first-party game releases. Geography matters less than mix. Revenue growth was fairly consistent across regions. The real story is product mix. High-margin cloud services growing faster than lower-margin consumer and gaming businesses. Here's what that means. Microsoft's revenue growth is consolidating around cloud and productivity. Consumer and gaming are becoming secondary. But revenue is only half the story. The question everyone's asking is, are they actually making money on all this? Because here's where things start to look concerning, at least on the surface. Based on reported revenue and cost of revenue, gross margin was approximately 68%, down slightly year over year. But here's the thing, that top-line number hides what's actually happening underneath. Here's how margins moved by segment: productivity and business processes. Microsoft doesn't break out the exact margin by sub-product here, but management emphasized efficiency gains in Microsoft 365 Commercial Cloud. Intelligent Cloud? Margins decreased year over year due to AI infrastructure investments and product mix shifting toward Azure. But within Azure specifically, margins are improving from efficiency gains. More personal computing, margins increased due to sales mix shifting to higher margin businesses. So why are margins compressing overall? 3 reasons. And all 3 tie back to the same thing. AI infrastructure coming online faster than revenue can fully absorb it. AI infrastructure costs. Microsoft is adding new GPU generations constantly, so costs are layering up before revenue fully scales. Growing AI product usage. Every Copilot interaction, every GitHub code suggestion costs compute. These products are still ramping. Costs are front-loaded, partially offset by efficiency gains. Management cited on the call a 50% increase in throughput for OpenAI inferencing and improvements from liquid cooling in Fairwater data centers. Now, let's look at operating expenses, because something interesting is happening here too. Operating expenses hit approximately $17 billion, up 5%. R&D increased due to compute capacity investments and AI talent hiring. Spending is rising on both fronts, CapEx for infrastructure and OpEx for the people and R&D to run it. They also recorded impairment charges in gaming, write-downs on underperforming assets. So where does all this leave us on profitability? Let's look at the actual numbers. Operating income, up 21% to $38.3 billion. The calculated operating margin hit approximately 47%, ahead of expectations. So, despite all the infrastructure spending, they're still expanding operating margins. Cash flow from operations, $35.8 billion, driven by strong cloud billings and collections. Implied free cash flow after capital expenditures was roughly $6 billion, down sequentially. Why? Higher cash capital expenditures, $29.9 billion, because fewer costs were covered by finance leases this quarter. They returned $12.7 billion to shareholders through dividends and buybacks. So, what's the bottom line here? Microsoft is profitable and cash generative, but they're choosing to compress margins today to build AI infrastructure for tomorrow. So that raises the obvious question. What's the strategy here? Why compress margins now? Why hold back Azure capacity? What are they actually building toward? This is where the pieces start to come together. Let's talk about what these numbers reveal about Microsoft's actual strategy. Because once you see it, the whole picture makes sense, and you'll understand why Wall Street is asking the wrong question. The numbers reveal 3 strategic priorities. Priority 1, build the full AI stack, infrastructure, platform, and applications. So, what's the evidence? $29.9 billion in property and equipment additions this quarter, plus additional capacity funded through finance leases. Based on management commentary and analyst interpretation, roughly two-thirds appears to be going to shorter-lived assets, GPUs and CPUs, that depreciate quickly but generate revenue immediately, while one-third goes to longer-lived infrastructure, land, power, data centers that will support revenue for years. CEO Satya Nadella said on the call they're optimizing tokens per watt per dollar, essentially AI efficiency. And here's what's interesting. Microsoft now operates a fleet with NVIDIA, AMD, and their own custom chips. Management discussed on the call bringing their Maya 200 AI accelerator online this quarter, with improved total cost of ownership versus prior generation hardware. They're not locked into any single vendor. Priority 2. In a supply-constrained world, fund first-party AI products alongside Azure customers. How do we know? Management reported on the call that Microsoft 365 Copilot seats grew 160% year-over-year to 15 million paid seats. GitHub Copilot subscribers hit 4.7 million, up 75%. These products consume the same infrastructure that could otherwise serve Azure customers. So they're making a choice. Build their own software products on top of the infrastructure rather than just selling raw compute. Priority 3. Lock in long-duration contracts before building capacity. Average RPO duration extended to 2.5 years according to the filing. Management indicated on the call that for GPU contracts specifically, they're selling commitments that extend across much of the hardware's useful life. And here's the proof. $625 billion in remaining performance obligation according to the filing. They're not building speculatively. They're building to contracted demand. So what's the trade-off? They're sacrificing near-term margins and Azure growth rates to build a portfolio of high-value AI products. They're betting that owning the application layer, Copilot, GitHub, security, delivers better lifetime value than selling raw Azure capacity. Now, what are the risks here? Memory price increases could impact CapEx costs and Windows OEM demand as PC manufacturers face higher component costs. Execution challenges in search advertising as third-party partnerships normalize. Gaming content performance variability. The big picture? Microsoft is treating AI infrastructure as R&D that happens to also generate Azure revenue. But here's where it gets really interesting, and where most analysts are getting it wrong. Because there's a hidden story in these numbers that changes everything about how you should value this company's AI investments. And I'm about to show you exactly what it is. All right, here's what most coverage is missing. And this is the part that changes how you should think about Microsoft's capital expenditure strategy. This is the insight that makes everything we just covered make sense. Everyone's focused on the $29.9 billion in property and equipment additions this quarter, but look at how it's actually flowing through the business. This is where it gets fascinating. Based on year-over-year comparisons in the filing, here are the actual revenue changes. Productivity and business processes. Revenue grew by $4.7 billion year-over-year. Within that, LinkedIn added $495 million. Dynamics added $291 million. Intelligent Cloud revenue grew $7.4 billion. Server products and cloud services, which includes Azure, added $7.2 billion of that. Now here's where the numbers stop lining up with the headlines. Look at margins. The filing shows Microsoft's overall margin pressure is being driven by AI infrastructure investment and growing AI product usage costs. And you can see the shape of it. Productivity is holding up better on margin, while Intelligent Cloud absorbs the infrastructure build. Here's the mistake Wall Street is making. They're treating Microsoft's AI spend like a cloud investment, when it's actually a software portfolio investment. Microsoft is building two AI businesses simultaneously: Azure for developers and enterprises, and Copilot products for end users. The payoff isn't just in Azure growth rates, it's in higher value software experiences layered on top. Amy Hood made this explicit on the call. She said that investors should think about Azure, but should also think about Microsoft 365 Copilot, GitHub Copilot, Dynamics Copilot, and Security Copilot, all of which have a gross margin profile and a lifetime value. Let me show you what that could mean in practice, because when you do the math, it's stunning. Let's do a back-of-the-envelope scenario here. And this is not company guidance. If Microsoft 365 Copilot reaches 30 million seats, double current levels, at something like roughly $30 per user per month in current market pricing, that's roughly $10.8 billion in annual revenue potential. That's directionally useful, but pricing, attach rates, and usage costs will decide the real profit. If these products carry software-like margins rather than infrastructure margins, the gross profit dollars could exceed what Azure generates on equivalent revenue. Wall Street is treating CapEx as an Azure investment. Microsoft is treating it as a portfolio investment across multiple products with different margin profiles. So this is the story hidden in the numbers. The ROI on AI CapEx won't show up only in Azure's growth rate. It shows up in a portfolio, Copilot seats, GitHub Copilot, and the apps layered on top, while Intelligent Cloud absorbs the build cost. And that's why the stock reaction doesn't make sense. Investors are measuring the wrong thing. So, knowing all this, what should you actually watch next quarter? Because now that you understand the strategy, there are 3 specific metrics that will tell you if it's working. Next quarter, Q3 fiscal 2026. I'm watching 3 specific things. And if you understand what we just covered, you'll know exactly why these matter more than the headline Azure number. First, Microsoft 365 Copilot seat growth. Current level, 15 million paid seats according to management commentary. What to watch? Does quarterly seat addition accelerate again? This quarter, they reported seats growing 160% faster than Q2 last year. If momentum holds, the next milestone comes fast. Because they're already at 15 million. Why it matters. This is one of the cleanest AI monetization KPIs they disclose, because seats are paid and recurring. Second, Azure constant currency growth, and the explanation. Guidance, 37 to 38% for Q3. What to watch? Whether growth stays in that range is important, but here's what really matters. Listen for how management explains capacity allocation. Are they still prioritizing first-party products over Azure customers? Why it matters. It signals whether the portfolio strategy is working or if Azure revenue pressure forces a shift. Third, capital expenditure trajectory. Current level, $29.9 billion in property and equipment additions in Q2, plus finance lease additions. What to watch? Management guided to a sequential decrease in Q3 due to timing of finance leases and deliveries. Does it drop materially or stay elevated? Why it matters. High CapEx is only sustainable if gross profit dollars grow faster. Next quarter's gross profit growth will tell you if the investment thesis is working. We'll be back next quarter to see how these played out. And to see if Microsoft's bet on the portfolio strategy, not just Azure, is paying off the way they claim it will. If this breakdown was useful, subscribe for more. Here at Show Me the Numbers, we read the report so you don't have to. And we focus on what the numbers actually say. No hype, no predictions, just the numbers. Thanks for watching, and I'll show you the numbers in the next one.